Using CFDs to hedge. Aside from utilizing CFDs for speculative gains, contracts for differences can also be used as a powerful risk protection tool for those who understand the power behind this simple investment product. Hedging is the action of taking an equal yet opposite position, usually through a derivative, such as a contract for difference, in order to mitigate or reduce the risk of an existing open position. Here, it's really important to understand that at any time you hedge your financial position, you are accepting that you may also lose some potential profit. There's always a trade-off, and hedging is like an insurance policy. It's a preservation strategy rather than a way of making money. So there is a price to pay in terms of lost profits, but a correctly implemented hedging strategy will avoid you having to take large losses. A hedge also allows a trader to offset any losses in a long position with profits from an opposite short position. Now, let's say you have a portfolio of shares and you're concerned that a market downturn is imminent. You may wish to hedge against this event. To avoid losses, you'd simply sell your shares, wait while the value drops, and then possibly buy them again at a lower price. But this would be speculating on a market fall, and that's a separate exercise, rather than hedging your portfolio. After all, you may need to consider that the market just may not fall. Hedging example. The ability to go long or short and to leverage trades makes CFDs a good tool for implementing hedging strategies. Now, if an investor has a physical portfolio of shares, commodities, or foreign currency, and he believes he could take a hit in the coming weeks, he could hedge that risk by taking an opposite position with a CFD. Let's suppose that it's the last week of January and an investor holds a portfolio of blue chip stocks worth about £55,000. The FTSE is trading at 5,005. For capital gains tax purposes, the investor would prefer not to sell his shares until the new tax year in April, but is still concerned that his portfolio would fall in the meantime because of widespread troubles in North Africa. So he decides to buy one short CFD on the FTSE at £10 per point, and this provides him with a £55,000 short exposure on the FTSE index. Now on the 10th of March, the FTSE falls nearly 8% to around 5,060, and the drop has wiped out £4,200 off his stock portfolio. The CFD has moved 440 points in his favor, and this has earned him around 4,400 profit on the trade. For only a nominal amount, which would include financing fees, he has bought himself an almost perfect short-term hedge. Here's when to get involved. When the wider market or a particular stock you are invested in is moving against you, or when a position has already moved sharply in the direction of your trade and additional gains may be marginal. You can also get involved when the wider market looks weak and doesn't react to negative or positive news. Here's when you should avoid hedging CFDs. When a trade has moved sharply against you, the market is prone to reversing, and where hedging near these levels, all you would be doing would be locking yourself into a large loss. You'd also avoid CFD hedges and avoid hedging in general when raging bullish markets are happening. For more information, visit www.contracts-for-difference.com.